Okay, so we all have hit a few roadblocks in our life. You may have lost a job, you got a new job, maybe you had a bankruptcy, or you might be like me and you're self-employed and you do everything you can to kind of minimize that tax payment. Well, the good news is that you don't have to let that stand in the way of you buying your dream property. Today, I'm going to go through some of the steps that just will allow you to buy a property without all the bank verifications and bank approvals. So if you've heard about owner financing or seller financing or an owner carry at all, and you're just curious how it works, grab a pen, grab a paper. You're definitely going to want to watch this video. So what is owner financing or seller financing, like some people like to think about? Well, think about it like this. You're going to go to your neighbor and you're going to buy a car and you're going to buy it directly from them. You're not going to go to a dealership and finance it through them. It's the same thing when you're buying land or even a house for that matter. If you go directly to the seller and the seller's willing to make a negotiated deal with you on the property that they want to sell, they might be able to be their own bank. That's what this all is. You don't have to go through credit unions or local lenders or anything like that. Sometimes you can go directly to a seller and come out way better ahead, and again, not have to go through all those hoops that you would if you were going through a regular mortgage type situation. All right, so first, what are some of the advantages of owner financing? Well, first of all, there's going to be minimal requirements. Again, it's not like you're going to a bank and you're going to have to bring all of your documents and your firstborn and your blood type and all that other stuff to make some underwriter stuck in a closet somewhere happy. If you could convince the landowner that you have credit worthiness, that you have the ability to pay this loan, that you have the cash up front for a down payment, and that you're not going to default, it becomes pretty easy. Now, some landowners may ask for, proof of funds for that down payment and stuff like that, but it's a lot less of a requirement than having to go through the traditional process with a bank. Second big advantage is a lot of times there's going to be a faster closing. Now, you're going to have to hire an attorney, and usually a title company, or in your state it might be just a closing attorney or a fee office will have a recommendation for you. Attorney's going to draft up the paperwork for that note, and that's what it is. Just like you would sign if it was a mortgage on a house, you're going to sign a note with that landowner promising to pay them back. But those attorneys do these things quite often, and it doesn't take them long to put these notes together. So realistically, you can close this almost like a cash deal. It can be done in as little as 2 weeks. So you could go from finding your property, negotiating a deal, to owning that property in as little as 2 weeks. The third major advantage is that there's flexibility in the terms. So if you go again to a normal mortgage, you're going to pay a par interest rate. So with owner financing, sometimes you can get better than that par or average interest rate. Now, sometimes the owner is going to go, no, it's an owner finance deal. I need to make a little bit more money. So you may suffer, but it's a negotiation. You're going to the landowner and you're saying, hey, what will it take for you to lend this to me? And you can negotiate. You can negotiate interest rate. You can negotiate the amortization period. A lot of times, if you're getting a land loan, you can only amortize it for 15 years if you're going to a credit union or something like that. But with the landowner, you may be able to amortize it for 20 or even 30 years, which reduces that monthly payment while you're carrying that note. So that type of flexibility can save you a lot of money up front. And then on the interest rate, let's say the landowner wants 8% and you would rather pay 5%. Okay, we'll negotiate it in between, make everybody happy. That's, again, one of the great things about this is as long as the landowner's happy, as long as you're happy, go close the deal and then pay the landowner his money. You go do with the land what you want to do. The last major advantage, and this is more if there's a house on it or some types of structures already where it would be compared to a normal mortgage, you don't have to carry mortgage insurance on this. So if you can convince the landowner, again, a part of the negotiation, that you're only going to put 5 or 10% down, if you were going through a traditional funding mechanism like a bank, you would have to then pay a private mortgage insurance on top of that. With owner financing, you're not going to have to do that. So if the owner's good with your down payment being less than 20 or 25%, you're good. Your payments then are just going to be based on principal and interest. Second thing we're going to talk about here is who is this a good fit for? Who is a good candidate for seller financing? I mean, the short answer is anybody, but specifically, and I mentioned this earlier, if you're somebody like me, if you're an investor, you're an entrepreneur, or you're self-employed, and you've got a lot of write-offs throughout the year, I mean, you may be able to take a gross income of $300,000 or $400,000 and write it down to where you're only showing about a $20,000 profit on paper. Well, that's great for your bottom line, but most lenders are not going to lend you money if you're only making $20,000 a year. So investors, entrepreneurs, self-employed people are great candidates for this type of loan. Another good candidate for this is somebody who has, we'll call it untraditional occupation. Maybe you make a lot of cash and you don't have a lot of income that you can show on a W-2 or a W-9 or anything like that. Also a great opportunity for you. And also the other people that this is a great fit for are those with unconditional income. Let's say you make a lot of your income in cash and you don't have like a W-9 or W-2 or a 1099 to show anybody. Well, if you've got the cash in the bank and you have the ability to repay it, a seller would be able to lend you the money or lend this land to you and let you pay for that as it goes. Also, if you're in a job transition, a lot of people don't know if you're going from one line of work to another, if you don't have a year to 2 years of history in that line of work, most traditional lenders or lending institutions are not going to lend you that money. So if you changed jobs recently and you can't get a traditional mortgage, this would also be a good opportunity for you. And the other person that this is always a great opportunity for, somebody who's looking to hold that land as a little bit of an investment. If you're going to go to a bank and you're going to have to put 20 or 25% down on land, and then you're going to have to pay, a bunch of fees above that, it can get a little bit expensive if your idea is to develop it later. But if you can go in, to the landowner and you can put less than 20 or 25% down, you can hold on to some of that cash and you can use that cash to invest back into the land. So if your plan is to do some development, and that may be, a subdivision, or it might even just be, putting in water and electric and stuff like that, holding on to that cash is ideal. And if you don't want to have to pay a bank, if you don't want to have to take out a construction loan to start that building process, then seller financing also really, really good opportunity for that. All right, next, let's talk about requirements. And I've seen some other YouTube videos where they're saying, well, there's a standard way to do seller financing. Standard is 10% down, blah, blah, blah. There's really not a standard with owner financing because, again, this is a negotiation between you and the owner. They can dictate their terms if you're okay with those. But if the landowner's like, I've got to have 15% down and you just don't have that kind of money, okay, well then negotiate down to maybe a 10% down or 7% down. So there's really not a standard on this. But the first thing that's negotiable is the down payment. After that is the amortization period. Again, if you're going to, say, Capital Farm Credit or Citibank, and you're trying to get a raw land loan, well, they might let you amortize it over 15 years. And that means that those payments are, the amount you pay every month is based on if that loan was going to be carried out for 15 years. That's an amortization schedule, okay? Sometimes you can get a 20-year amortization, but really on raw land, it's really hard to get more than that. So again, the amount you're having to pay every month is a little bit high. So what you can do again in owner financing is you might be able to get really flexible with that amortization. And if they're okay with a lower monthly payment, as long as they're getting the rest of their terms, you might be able to amortize that land over a longer period, like 30 years, which is what you would traditionally get with a home. And you're not going to get that when you're buying raw land. So again, amortization schedule, another one of those negotiation points in there. Along with that amortization period, what's usually going to happen with seller financing, there's going to be some type of term balloon on it. And what that means is, okay, you might be able to amortize that loan over 30 years, but the owner's only going to allow you to have that loan for 2 years. So you've got a 2-year balloon. After that 2 years, now you have to find traditional financing for the rest of that. Not really a big deal, again, unless you're trying to hold on to it long-term before building or before developing. In that case, you might be able to get a 5-year balloon. You may be able to get a 3-year balloon with 2 extensions. And you can be really creative in these. And I've even seen a 7-year balloon sometimes, so you can hold that land long-term with a little bit of a lower down payment. So that's what that balloon is. But at the end, you're going to have to pay that off. Now, most people are not going to be deterred by that, just because if you've got a 2-year balloon, most people are going to start, if your idea here is to build a house, most people are going to start designing and then look to start building that house within that first 2 years anyway. And when you do that, if you don't have the cash to pay for that construction on your own, you're going to end up going and getting a construction loan, and that construction loan is going to require the payoff of that seller finance loan. So again, if it's a 2-year balloon, as long as you go get your construction loan before the end of that 2 years, you're good. Now that construction loan is going to pay off the owner financing, and then moving forward, once your house is built and you've used up that construction loan, then you're going to refi it into a permanent mortgage with a more traditional bank, you know, the 30-year amortization with a conventional loan type situation. So that's the last thing in there, is you are going to be able to hang on to that cash just a little bit longer, but you are going to have to pay that note off at that balloon period. And then the last thing in there again is that interest rate. Now, if you talk to most people, and if you look around on YouTube, all right, they're going to say, well, you're going to expect to pay a 1 to 1.5 percentage point premium over what you would get in a bank. Sometimes that's true. Sometimes that's what owners require, and you've got to be okay with that. But I've seen a lot of owner finance deals that are actually cheaper than what it would cost you to go, get a land loan at a bank. Now, you can't go to a traditional bank and get a land loan. Like, you can't go to Wells Fargo and get a land loan. First of all, you're more than likely going to either deal with a co-op. In Texas, we have Capital Farm Co-op, and there's a local bank here. There are a couple of local banks. That's your other best option for that. Here we've got Citibank, CITY Bank, not that big one. This is a local one here. And a couple of other locals, Pioneer Bank's another one. But usually when you get a land loan, there's more risk there. So if you look at what an average mortgage rate is for a house, right now at the shooting of this video, an average mortgage rate's about 6.5. Okay, well, if you get a land loan, you can expect to pay probably 8 to 8.5%, which is a 1.5 to 2 point premium above what a traditional mortgage is. But again, this is going to the seller and finding out from them, hey, what will you accept? Just because a house mortgage is 7.5% or even 6.5%, if a CD at this point in time is generating 5% interest, well then why wouldn't the landowner give it to you for 5.5%? And that's the way you have to negotiate with them. Hey, what are you going to do with this money? Are you going to go put it in a bank? All right, you're going to get maybe 4.5, 5%. All right, I'll give you a 0.5 percentage point over that. I'll give you 5.5%. Now you're less than what you would get at a traditional land lending institution, but you're also making that landowner happy because they're getting more than they would get in a bank. Again, negotiation is everything with these things, and no term in any of these is unnegotiable. This is an agreement between you and a landowner. Now, you may have an attorney that doesn't like some things, and you'd have to talk through that with them, but as long as the landowner is good with it, and as long as you as the buyer are good with it, you're good to go. All right, so there are some potential downsides, and I mentioned one of them already, and that's that balloon payment. Again, maybe that landowner has got to have their cash out at the end of 2 years, and your idea was you wanted to hold on and start building maybe after retirement, so you were going to try to hold it for 5 years before you got a construction loan. Could be a downside. You're going to have to work through that with that landowner, but that's a potential downside, that balloon payment. Now, this next one, it can go either way because I've seen them structured a different way. First of all, there's a lot of lack of legal protections here. When you go get a mortgage on a house, the mortgage lender has got to follow all of these government regulations. And even when you get a loan on a land from a traditional institution, like I was saying, Capital Farm Credit or Citi or Pioneer, there's a lot of government protections in there, and it's consumer protection stuff. So it's designed to protect you as the buyer. But when you go directly to the owner, you don't have those protections necessarily. So you have got to have a really good attorney who can look out and who has done these things before to make sure that you're being taken care of. Now, there's another option in some states, and Leahy Lending is a lender here in Austin, Texas, and they operate, I know, in Florida, and I believe they're starting to operate in California now, and they're trying to open up into other markets. But they do all of this for you. They work with a lot of attorneys that have done these types of loans for a long time, and so they kind of act as that middleman. And yes, you as a buyer are going to pay them for that right, but they put all of these legal safeguards in place to protect you as the buyer. So, if you're going to do this the traditional way of a seller finance where you're not going to approach somebody like Leahy Lending, okay, make sure you've got a really, really good attorney. If you want a little bit more protection, you can go to somebody like Leahy Lending, and they have the attorneys that will protect you as a buyer. One of the downsides about doing that is it's going to cost you a little bit more just in terms of preparation and stuff like that, and they're also going to run all of your background checks and income checks and stuff like that a little bit more like a traditional mortgage. Now, at the end of the day, they're going to do all of that to protect the seller, but the seller doesn't necessarily have to look at it like a traditional lending institution. So, you may be able to tell the seller, hey, look, I get paid all cash, so this is not going to come back good, but my credit's good, and that's what they're going to show you. And I can show you all the cash that I've got in the bank and all the cash that I make monthly. So, hey, we're going to use Leahy Lending for this, but you have to understand this is my limitation as a buyer. Will you still sell me this on seller financing? And again, if you can make a good argument and you make the landowner feel good that they're not putting too much at risk, a lot of times you can get to a good agreement with them. And then the last potential downside again is that interest rate caveat. Like, a lot of sellers don't really understand that it's a negotiation. So in their minds, if they hear owner financing, oh yeah, I'll owner finance it for you. You're going to put 50% down and you're going to pay me 10% a month or 10% interest yearly. That's not going to work, obviously. So you may have to educate that homeowner or the landowner on that interest rate. Like, hey, look, can't do 10%. That's kind of dumb. I would just go buy a different piece of property. I really like your property. Let's talk about something more in this 5.5% range or 6% range, and again, see if they'll negotiate with you. Next thing I'm going to cover here is lies about owner financing, common myths, misconceptions, however you want to say it, but things that just aren't true about seller financing. The first one is people say, oh, seller financing is for people with bad credit. And that's what a lot of sellers think, honestly. And that's not true. Again, you may have great credit. I have 800 credit, but because of the way that I run my business, I don't show a lot of income. So I can show them that I actually have made the money. I can show them that I have 800 credit, but I just can't necessarily go that traditional way. So again, you have to overcome that misconception sometimes that you've got bad credit. That's the way you want to do it, but that's what a conversation's for. The second misconception that I hear about is if I do have to pay a higher interest rate, let's say that you can't get that owner off of 8 or 9% interest, then it's a bad deal. Okay, maybe, but maybe not. Because if you have to pay 9% interest for 2 years, but you only have to put 5% down or 10% down, that may be a better deal than going the traditional route where you're going to have to shell out 20 or 25 or maybe even 30% down. So it all depends on what your strategy is and what you want to do. If you can't get that owner off of a higher interest rate, run the numbers anyway. It still may make more sense to do an owner finance deal. Next misconception is owner finance deals are hard to find. Absolutely not true. If they're in the MLS, your realtor can search them by financing type. I can have a search up and running in 5 minutes over an area that finds every owner finance deal that is on the market. Okay. If you don't have any of those on the market, if they're not advertising them as owner finance, it still may not be that hard. You may just have a seller that was never given a conversation about that by their listing agent. So your agent or you can always go directly to the listing agent and ask them, hey, is the seller willing to negotiate a seller finance deal? And a lot of times they will be, or they can be convinced to do it, again, if you are a good buyer for them. So they're not always hard to find. And again, I can search them in the MLS. It's a real quick filter and it's easy to do. Another misconception is that sellers can't do owner financing if they have a mortgage on the property. Again, not true. If you go to an agent or if your agent runs up against that and the other agent says or the owner says, I can't do it, there's a mortgage, you can still do it. There's legal ways to do it. Sometimes they call them wraps or it can be subject to financing and things like that, but you can still do owner financing, at least some creative methods around it, even if there's a mortgage on the property. And it doesn't necessarily have to pay off the monthly payment every month as long as the landowner is good for that. So if you go looking for an owner finance property and they say, nope, can't do it, there's a mortgage in place, educate them or have your agent educate them that it's still a possibility. Now, just because the financing in your deal may not be traditional, that doesn't mean that you should take shortcuts on the rest of your deal. Here's what I mean. In every transaction, make sure you get a title policy. Do this the legal way in your state, whether, in Texas, again, we have title companies here. You may have an attorney that does this in your state or a fee office or a closing office, whatever that is. But make sure you get title insurance to ensure that you've got a true right to that property. I've seen it happen. Oh my gosh, I've seen it happen where a seller goes in and they negotiate a deal with a buyer and the buyer thinks they own it, but they didn't get title insurance. And the seller didn't even have the right to sell the land. So the buyer's been paying them, paid them 10, 15, 20% down, has been paying them monthly. and it wasn't the seller's land to sell. They didn't know because they didn't go through a title company. So make sure everything goes through a title company all the time. That is your major legal protection in this process. Okay. The next thing you're going to want to make sure you do on every transaction is get a survey. Now, me personally, when we're dealing with raw land, I want a brand new survey. I don't care if the seller had a survey done last year. I want to get a brand new one. I want to be the one that pays for that survey, and it can get expensive. I mean, 10 acres could run you a few $1,000s, here in Central Texas. But I want to make sure that I get the best survey that I possibly can, so I know exactly where my corners are. And while the survey is going on, you can get that survey company to go out there and put pins in certain locations. Let's say you want to put up cross fences, and you know that. We'll tell the surveyor or pay the surveyor to go out and put pins in different spots where you might want them. Or if you're going to put a boundary fence where there's no boundary fence, they can put pins along that boundary fence. And as long as you've got, they'll mark them, but if you lose the marks, as long as you've got a metal detector, you can go back years later and find those pins and put your fence up right where it's supposed to be. But at the end of the day, make sure that you get a survey. And my recommendation is to get a brand new survey, even though they can be pretty expensive. The next part about making this every other part of it like a traditional transaction is make sure you go out and you walk the property. Go out when it's raining, go out when it's snowing, go out when it's dry and windy. Get on the property as much as possible and walk it and look for potential issues. Also, make sure you're going and looking on the FEMA website to see if there's floodplain, or if there's any, a lot of times on county websites, you can see if there's an old abandoned well on there or something like that. Do your due diligence all the way through. Again, you don't want to go and buy a piece of property that you can't do anything with. So make sure with the county that you can put a septic system in if you need that. Make sure there's electricity available nearby and that you can actually afford to bring it to the property. I've seen electricity cost up to $80,000 to get to a property less than a quarter mile away. So it can be expensive. Make sure you're doing all of that due diligence just like you would do on any other type of transaction. The next thing is make sure that you have your end goal in mind. Again, are you buying this for an off-grid place? Are you buying it to farm? Are you buying it to homestead, put cattle on, buying it to build your dream house? Whatever it is, make sure you have that long-term goal in mind, because again, that's going to affect or could potentially affect the terms for this owner finance deal. If you know that you're going to build a house in the next year and a half and you've got the plans and you're ready to go, okay, that's fine. You don't need a very long balloon on that. And the landowner knowing maybe you only need a 1-year balloon or a 2-year balloon, okay, that's going to be incentive for that landowner, because they know that they're going to get all of their cash out of that transaction in the first couple of years. But again, if you're trying to hold this thing long term before you do any development on there, you know up front with your negotiations, I've got to get at least a 5-year balloon on this, because I'm eyeing appreciation down the road, and I'm going to do a development here, and I'm going to subdivide it and sell 5-acre ranchettes out of a 1,000-acre property that I'm buying. Okay, know that up front and know what you've got to do to get to that point, and then negotiate that owner finance deal accordingly to what your goals are. Now, I'm just going to reiterate with you, owner financing is not a really scary thing. It gets a negative connotation sometimes, okay? And let's be honest, there are sellers that the whole reason they do owner financing is because they know that the buyer has a low likelihood of being able to pay it off. And as a seller, if your buyer defaults, you get the down payment, you get all the monthly payments that they've made, and then you get your property back at the end. So there's been some sellers that have given it a bad name, but overall, if you've got a good team on your side, there's no reason to be scared of them. And a lot of times you can get a better deal with an owner finance deal than you would going to a bank. Could save you thousands and thousands of dollars. But remember, I said, you've got to have a good team. You need to have an attorney who is really, really well versed in owner finance deals. You need to have a title company who knows what they're doing as well. Okay, the financing part of it is going to be written by an attorney, but the title company is going to verify it and file it with the county or the state, whatever they need to do in your situation. But that title company has to make sure that they have all the correct documentation to file, because from their point of view, it's just like a normal finance deal. It's just that the money's not coming from Wells Fargo. It's coming from the owner. So make sure you have a good attorney, make sure you have a good title company, and if you need a good agent, make sure you get one. You don't always need it. If you know what you're doing and you can handle this and you've done this before, great, go for it, knock it out, save yourself the money. But if you do not know and you haven't done this before and you're kind of on the internet figuring this out as you go, reach out to me, reach out to another agent in your area. Make sure you find somebody who's done owner finance deals before and has a team that they can recommend to keep you out of trouble. Of course, I'm going to make money on the deal, but if I can prevent you from losing $30, $40, $50,000, or if the whole deal goes sideways, maybe $100,000, I'm worth my weight in gold. That's why you hire professionals. Again, that's why you hire an attorney. That's why you hire a title company. If you need help from an agent, go find a good one. If you don't know where to look in your area, reach out to me. I know agents all over the U.S. Be more than happy to make an introduction to you.